Hello everyone, welcome back to another episode of Simply Investing. Well, it's been a crazy start to the year. Lots of craziness going on. Oil down below 30, at least the last time I checked before the market closed. But oil, I think it ended at 29.52. So, like I anticipated, oil down to pretty bare bottom numbers. Even Goldman Sachs is saying, hey, this is going to be around $20. We're going to be in trouble if it gets to around 10. So it looks like that bubble burst. The bad loans in that sector are bursting, although a lot of big banks that have loaned money to energy companies, are they should have reserves for it. However, I still think we're in a good position, because I believe a lot of airlines like JetBlue, great price, they're expanding, they're generating revenue, they're generating profit. I don't know why they're just going down. Fuel costs are going down, they should be going up. They're gonna make a tremendous profit this year. Watch. I think they're at like $19.90 a share. I'd start buying it, because I really think that's going to be over $30 by the end of the year. Maybe a year and a half, depending on how long oil stays down. But I think oil is going to stay down for a long time. And coming to that oil decision, it's just like I said, it's not just the fact that they overproduced, it's also the fact that that consumers, even the cars that are coming out, even if you bought a truck, the truck 30 years ago isn't even close to the fuel efficiency of a truck today. If you bought a Bronco at 1990, the fuel efficiency was what, 8 miles to the gallon and 15? Not even that, maybe 13 on the highway. Now you could probably get away with getting a SUV and it's saying 18 miles city, 25 highway. No, there's a lot more hybrid cars out. Ever since the gas prices went up, a lot of people started switching to like Priuses or hybrid alternate cars, which save you a ton of money. And that comes back to, again, that it saves a ton of money when you do that. So one would think that consumers have, okay, now we got more money we're going to spend. No, that is not the case. There are more millennials now are taking effect on the economy. Millennials saw the overspending of their parents' generation and are not doing it. But they do it so to the extreme. They don't buy quality goods at a low price. They buy the cheapest goods possible at the cheapest price possible, which is also causing this calamity, because it's forcing companies to keep averting jobs overseas for cheap labor just to make ends meet. So it's going to be interesting. Retail wise, I would say my best bets are Macys and Walmart. I've already put positions in them. Walmart, because they're just a big discount store. They'll always be here. They'll always make money. They'll always make a profit, because low-income people don't shop Amazon. I don't know how many times I have to say for people to start realizing low-income people don't shop Amazon. You're not going to spend $200 on a service that you can hardly use. Exactly. So that's why I was thinking, like, Amazon's eventually going to go hit the brakes and bang into the wall, because there isn't a lot of middle class people. Middle class people have to spend a bit more. There's just no reason to have an Amazon account unless if you're frivolously spending money. If you're on a tight budget and you got a plan, trust me, Amazon's not in there. And it's cheaper just to have cable than it is to have internet and all that other streaming bullshit. So I think Amazon's going to stagnate in the next few years. and people are not going to know what to do, and probably cause another market crash. Who knows? But Macys, I also think will be around, even though they're shuttering stores, closing down some stores. I think they're a great buy because they sell luxury brands. I mean, people still have a status quo that they like to hit, and they like to make sure that everyone knows that they have money, or at least have the appearance that they have money. So, I mean, I don't think it's going to be over $80 a share, but I do think it will climb back up into the 50 range. I mean, it pays a dividend, for Christ's sakes. It's one of the few retailers out there that still pays a dividend. And, people always say, well, Amazon's hurting your sales. No, Amazon doesn't hurt Macys sales. Macys sales is solely derived off of luxury goods. Have you ever gone into Macys and then gone into JCPenney? Completely different products, right? Completely different experience, right? Their whole idea is that their stores look expensive. And trust me, they're more than happy to charge $30 for a t-shirt. And people will buy it over there. Why? Because it's Macys. You want to have the illusion that you're shopping at a luxury area. Because people know, if you shop out on Macys and Nordstrom, you know that that person's wealthy. If you shop at JCPenney, you know the person's middle class. And if you shop at Target and Kohl's, you know the person's in the lower class. And that's just what people assume about people who shop there. So with that said, those are kind of my plays. I also am going strong on JP Morgan and on Bank of America. And some people might wonder, well, why not Wells Fargo? Well, I already have a position in Wells Fargo, but I'm just diversifying my bank stocks a little bit and making sure that I have a little bit more, it's more spread out. Now, I think that JP Morgan, Wells Fargo, and Bank of America are all poised to really kind of significantly grow over the next 3 or 4 years. It's just a matter of time when people have faith in them again. I mean, they're not making loans as much as they used to. And that's one thing I think they should do. They should start doing residential loans and small business loans heavily. And I mean heavily. Not half-assed, half-hearted jobs, but heavily built into it. And if they can get back into loaning into small communities, that will help communities rebolster, and the economy will fix itself. Why they aren't doing that, I have no goddamn idea. But I do think that they're in a great position to start doing that. They are paying steady dividends, so although I would like Bank of America to increase a bit, but there you have. But I can't make that decision until I'm like a 30% shareholder. So a little bit of info on Robinhood. I just noticed, I don't know when it took effect, but if you scroll down on the stocks that you own, it shows a percentage of the portfolio. I think that is amazing. I like it a lot. I like it a lot. Because it's like, all right, now you know your percentage. So if you're in a risky area, or in an industry you don't want to risk a lot, you can kind of gauge your percentage in that area, and thus gauge your percentage of risk involved in it. So I just noticed that. I think it came with one of the updates. I like it. And so far the Robinhood app has been very good, very good. I have no complaints with it whatsoever. I have suggestions for improvement, as always. Still needs a lot of room for it to improve, but so far the platform they're running off of it is great. But now I want to see how the hell they're going to make money. Because if you're not making money off of trades, you got to make money off of ads. and that's fine. They can certainly limit the ads to investment related advertisements, because the odds are you shouldn't be using Robinhood as your sole machine to secure your financial future. It should be 1/10 of it. By that I mean you should have a savings account. You should have a savings account. You should have a 401k. You should have annuities, and then you should have an investment account that you steadily put in there every month, like with JP Morgan, Goldman Sachs, things of that nature. And you can have your own a couple trading accounts. Like you can have your Thinkorswim account, and you can have your Robinhood or your Betterment or your Wealthfront. But they shouldn't be the only avenue. They should be one of many avenues for your financial success. And that's part of the process of why people get stuck. Is that you shouldn't entrust everything into one avenue. Like before, everyone was like, "Oh, my 401k, yeah, the stock market was up, great." But you should also have cash on hand. You should have a great savings account, and you should be in the position by the time you're retiring that you don't have too much longer on your mortgage either. Maybe 3 to 5 years left on your mortgage, and that should put you in a great shape. Now, I've got nothing else for you guys. If you guys got questions, always feel free to comment. Join my Facebook page, Simply Investing 2015, or I'm Simply _investing, or I'm sorry, it's not that. It's Simply _invest 2015. Terrible with that. But, thanks guys for your feedback. Always feel free to ask me questions anytime. I'll try to respond as quickly as possible. Feel free to also chat amongst yourselves, because I kind of want this to be an open forum so you guys have a great avenue to research and help you guys pick stocks. With that said, I will talk to you later next time. Like and subscribe. Try and get over 100 subscribers. And also, hopefully, the next time you see me, I'll have my little area where I'm going to do all these videos set up. That said, good luck, good trading. Remember, always respect the process. Be patient. Don't get emotional. See you next time.